I like to start off every show, of course, with a summary about what I saw happening in the stock market this week. Of course, this is an amazing week altogether, as usual. We've got all these different things happening, but the biggest inputs that we saw this week really, of course, had to do with the Ukraine situation and the oil price increase that happened because of that. And then on Thursday, we got the inflation number that came out that was quite high. And so these are the things that the market is going to be grappling with going forward. And I'll give you some of my kind of opinions on what I see happening there as far as that goes. So the Ukraine situation is very interesting in that it's extremely difficult to kind of handicap that and figure out where it might be going and what might be happening next there. And really, the biggest impact that we see there immediately is, of course, the increase in the price of oil, and we've all seen increases of price of gas at the gas station. And the ongoing impacts have a lot probably to do more with what's going on with the sanctions in Russia. What types of situations will come from that? Will there be some surprises? Because sometimes when you shut down pieces and Russia maybe defaults on their bonds, you might have some surprises, some things that happen that we weren't expecting to happen. I would say those surprises are a little bit more mitigated here just because this conflict's been ongoing for some time here, and it's not an overnight surprise, but nonetheless, sometimes there's consequences to some of these things that we can't really see. So we'll have to watch for that and see what happens there. We did see something very interesting, I thought, this week on Wednesday. And I'll highlight Wednesday because I think it's important. Number one, Wednesday was up a lot. It was really good stock market. We ended up seeing, a big up day, and it was caused by the fact that the Ukraine president mentioned that, they're not as interested in joining NATO. So that was, something the market looked at as a possible, negotiating piece that might help with resolving the conflict there. And then we had the International Energy Agency talk about releasing some more barrels of oil, and then we had UAE talk about the possibility of increasing production of oil, and we saw the price of oil drop 11% on that day, and the market went up tremendously, and we saw some really big gains from growth stocks. And I think this is a really important clue to what's going to happen here as things do resolve themselves in Ukraine, and then eventually hopefully resolve themselves in the inflation arena. When people were running back into the market, they were buying these companies like Microsoft, which was up 4.6%. And if you looked at kind of I have a couple hundred different ETFs that I'm looking at on a daily basis. Most of the ones that were doing really well at that time were the growth-oriented ETFs. And I think that's an important thing to think about, where you want to be replaced, where you want to be placed when some of these things start to resolve themselves. And so that was a big key. I think that was interesting this week as far as that goes. But then the next day, Thursday, the inflation number came out, and it was 7.9% on inflation for this February versus last February. So big number, high inflation. And so obviously the next week is the Federal Reserve is meeting. So we'll have to wait and see what they have to say. I think that's important. And then what they end up doing in terms of raising rates. We're expecting a quarter point increase in March. Would be the first increase we've had really since they started decreasing interest rates 2 years ago. And so that's kind of a big deal. We'll see how that plays out. But one thing to keep in mind with inflation, and this is just a point that I think is interesting right now. I'm reading a lot of articles about what happened when inflation happened in the past. Here's how the stock market reacted. Here's what happens to earnings. Here's what happened to, the overall economy and recessions and all those types of things. And every one of these articles is missing one massive component, in that in those situations there was no pandemic. So there was no reopening where demand was exceeding supply, and there was no trillions of dollars of money pumped into the economy to try to support the economy during this pandemic. And I think you can make some mistakes here by kind of correlating what's happening, with inflation from the 70s and 80s to what might happen this time. And again, I think if you're not careful here, inflation could resolve itself quicker than people think because supply chain can start to improve. Demand can start to drop down just because the stimulus starts to burn off. And even more importantly, actually, a lot of people don't realize this, but a lot of the demand is being focused on goods and not on services. And so because people aren't traveling as much and they're not going out to eat as much, not going to movies as much, what happens when people start to do all those things is the dollar gets spread out over more area of the economy, and that will probably bring down some of the inflationary pressure on the goods because that money is starting to go in some of these other areas here. Now, oil is a big issue. It's something to think about. We'll have to wait and see what happens there. So we got one piece of Ukraine flooding over into the inflationary story, but nonetheless, I think we have to be very careful with assuming that we're going to have a scenario like we had before, and we have to be very careful with reacting to that and going out and just basically, investing in these things that would have worked in the 70s and 80s. Because if inflation comes back down, I think to look at what happened on Wednesday, look at what moved, and I think that's where we want to be placed. I think that's important. The whole concept at this point is to try to create recovery. The S&P 500 is down about 11% year to date. The highest point that it hit back in late last year to the lowest point it hit in the morning of the invasion on the 24th of February, it was down 14.6%. Again, those are normal downturns. The average downturn without a recession is 15%, so very similar to what we've done so far. And so really we're just watching for recessionary issues. And right now we're not seeing enough of those. There's some possibilities. There's some things that could happen, but really want to invest in probabilities, which right now the probabilities that inflation would be that a recession would be pushed out just because the economy is doing well. So very interesting week altogether. I think things are okay. We did not get back down below the low that was established on February 24th. We'll have to see if that low holds for the year, or do we go down a little bit lower. I wouldn't be surprised to see us go lower. But we'll have to wait and see. I think obviously the biggest wild card is what's happening in Ukraine and what might continue to develop there as far as that goes. So we'll watch and see what goes on in the interim until there's some recessionary pressure. Again, I think this is a chance to rebalance on these dips, and we rebalanced on the 24th of January and the 24th of February for our IRA accounts. I think that worked out quite well, actually. And so, just something we'll keep watching for. So look forward to kind of seeing what's going to happen next week. This is a very interesting time to be studying what's happening in the market, just so we can all kind of learn what to do in the future.